All right, let me just get this out of the way. All right, here we go. So in this chapter, what we're doing is looking at some tools that can be used for analyzing personal financial statements. So last week we looked at personal financial statements, how they are prepared, and the general guidelines. And so when you are reading chapter 13, or if you have already read chapter 13, you will notice that the tools are helping you to assess liquidity, they are helping you to assess solvency, and they are also helping you to evaluate just how strong the net worth is of the guarantor or guarantors. The other thing you want to remember is the degree to which you analyze the personal financial statements of the guarantor or guarantors will be dependent on A, the size of the loan, and of course, just how reliant you are on the financial strength of the guarantors. In some cases, Nelson, you will come across this as well. You get the guarantee or the guarantor to sign off because that's your policy. If we're lending X amount of dollars to a type of business, we require the sole proprietor or the owner to provide his or her or their guarantee, but it's not that it's required in order for the loan to be approved. So just bear that in mind as you go through your evaluation of the chapter and the personal financial statements. So remember, as far as accounting guidelines are concerned, the personal financial statements are based on what the preparer determines it to be. So it's going to be based on the current value, which is what a willing buyer and seller would be willing to pay for the item. Also, remember that the assets are listed in the order of liquidity. And I noticed that there were some challenges with regards to the order of liquidity and the order of maturity for the liabilities. So let me just say a couple things here regarding the order of liquidity. What we are trying to do is list the assets in terms of the ones that are most liquid, put those at the top, and then we kind of go down the list and end with the least liquid. One of the things that will determine the liquidity of an asset is whether or not there is a market for it. Because if you think about this, right, you can quickly sell your house. You may not get much for it, but if you wanted to have a fire sale or just to quickly get your house off your hands, you could sell your house. So you could argue, my house is liquid. But the way liquidity is defined in finance is how much loss are you going to incur in trying to dispose of, or let's say sell that asset. So if you can sell an asset with minimal loss, that asset is said to be liquid. So there would need to be some kind of market for that. And therefore, if you think about it, a note receivable from a friend, there's no market for that, right? You are hoping that the friend will repay, but you would not necessarily be able to get cash for it. Maybe you can find someone else who will be willing to give you pennies on the dollar, and they would go through the trouble of collecting from your friend. But again, your risk of loss on that transaction is going to be pretty high. On the liability side, we're listing the amounts in the order of maturity. And I should also share with you that this is really about businesses that follow generally accepted accounting principles within the United States. If, for example, you are doing this in the Bahamas, the first thing that will be listed is your mortgage, because they are really putting an emphasis on collateralized debt. And so just bear in mind that this is about generally accepted accounting principles, and in some places it may be different. So you notice in this case that the unsecured debt, it's on demand. So if you had a credit card balances, those would be listed first. In this case, we have a note, and then you come on down the list until you get to your secured obligations. But the general rule is that your liability should be listed in the order of maturity. So the ones that do not have a due date specific would be first because they're due on demand. And then you get into the ones that will have a maturity date. Appreciate that if there are only 2 years left on a mortgage, that mortgage could be above your boat loan if, for example, you have 15 years left on the boat loan. So a lot of this is going to be dependent on the information you get when you discuss the financials with the guarantor or guarantors. And the same thing applies on the asset side. Cash value of life insurance. Notice it's fairly low on this balance sheet because the owners have borrowed against the cash value. So as far as value, liquidity, excuse me, it's quite reduced. So I just wanted to share that with you because I noticed that several of you were listing some items like your 401k. You had it low down on the list as opposed to higher up on the balance sheet. And you probably had the receivables early in your list because normally when you see receivables, you're thinking current assets on the corporate or the business balance sheet. But we're talking here about liquidity, the ability to get cash from the item. All right, so one of the ratios that we use to assess liquidity, the ability to meet short-term obligations, is the liquidity ratio. This is not the same as the liquidity ratio that we use for a business. This one is simply saying what percentage of your total assets would you consider, the assets of the guarantor or guarantors, would you consider to be liquid? So in this calculation, what you're doing is you're taking the liquid assets and dividing that sum by the total assets. Hence, I emphasize you want to be sure that you list your liquid assets in the correct order, because when you're ready to do your calculation, all of your liquid assets should be grouped together. You should have some at the top and one all the way down at the bottom on the asset side. So in this particular case, you can see the calculation of the liquidity ratio. By the way, this standard, I should put a question mark beside it because there really is no standard that is agreed upon by everyone. So check with your lender, with your bank, and see what the requirement is. But I am arguing that it has to be, or it should be, greater than 10%. So 10% or higher would be considered an acceptable level. And even then, you have to take into consideration the age of the guarantor. If it's a young person, this may be less than 10%, and it would not be abnormal. On the other hand, if you have someone who is, say, in their 60s or retired, they most likely would have a higher percentage of liquid assets. So their liquid ratio would be greater than 10%. So again, general rule, the higher, the better. And you want to take into consideration the age of the guarantor or guarantors when you are evaluating this particular ratio. So what we are looking at here is for this individual, for the 2 years that we have, you can see that they tend to be pretty solid at 15% for their liquidity ratio. Again, the higher, generally speaking, that ratio is, the better. Then we have two debt ratios. And there's one that is called the unsecured debt ratio. I have UDR for short, where you take the unsecured debt, so debt that does not have any collateral associated with it, and you divide by the annual income. You can think of this as a kind of solvency ratio, but it's called the UDR, or unsecured debt ratio. So in this case, the unsecured debt totaled 26.4 or $26,400. You can see if I add these two, that's where I got that from. And I divided that by the annual income. The annual income is given here, and you would have obtained that from your conversation with the guarantors, or maybe it's part of the financial statement that they provided it. Again, you can see that for these particular individuals, the unsecured debt ratio actually went down, right? So here it was 29.1 and it dropped to 14.7. So this is actually an improvement in their unsecured debt ratio. It improved because even though their unsecured debt went up, you can see that their income went up, and therefore the overall unsecured debt ratio went down. Again, the general rule, at least as described in your textbook, is for it to be 20% or less. The other one is the one that you probably see a lot, because this is a similar calculation that is done if you were applying for, say, a mortgage or a car loan on the retail side of banking. And again, there is a general rule that says it should be 40% or less, and there are some lenders who will tell you that it cannot exceed 43%. I don't know what the policy is for your bank, but a lot of financial institutions tend to adhere to this benchmark of 40%, this standard of 40%. And you can see that this particular, these individuals, their debt to income ratio is very low. Now, I will tell you that I think that this is just not a good calculation that I did, because all I did was I took their mortgage, which is the only debt that has an installment payment, and I divided it by their annual income. I took their total income, divided it by 12, and this is the monthly income. I think a better calculation, a more conservative calculation, would have been to take even these unsecured and divide them by, say, 12, because even though they are unsecured, they're going to have to make minimum payments. For example, if it's a credit card, you have to make minimum payments on your credit card. So I would factor that in when I'm calculating this ratio, okay? So do not limit it in a practical situation to just installment debt. Even if you have unsecured debt that's on demand, like credit card, I would take at least the minimum payment and include that amount in my numerator. So this is impressive, and it shows us, if this were in fact the case, that they have a lot of room to take on additional debt if they were to do that, right? Because this is the maximum, let's say, and they are way below that at roughly 10%. And so to find out what that maximum is, you take 40% of their monthly income, which would be this number, and then you subtract the amount that they are currently paying. And so they could borrow an additional amount where the monthly payment is $2,595. So depending on the interest rate and depending on how long that money is going to be borrowed for will determine what the loan amount will be. But this is saying that you could extend the loan to this individual up to $2,595 per month in terms of the payment. All right, let's get to the last piece of this, which is there are two adjustments. So we went through the liquidity evaluation, right, with the liquidity ratio. We went through the solvency with those debt ratios. And now what we're looking at is the question of how strong is the equity that is being used to support the loan as far as guarantee is concerned. And so there are two of these calculations that are recommended in your textbook. One is called the outside net worth, and I think this one is pretty self-explanatory. But what you do here is you take the net worth as given. Okay, so here we have the net worth for the 2 years. We take for each year, let's say the first year we have of 921,300, and the calculation would be to subtract the value of the equity in the business that is being guaranteed. So if we're lending to this company, David Car Company, then we would subtract that, because what we're asking is, if this company goes belly up, then clearly this has no value. This would be zero. So the equity that they would really have available conservatively would be $447,000, not $921,000. It also tells you that the equity in their business is a huge percentage of their net worth. And you can see even here, 19x3, when their stated net worth is over $1 million, more than half of that, right, is represented by their equity in their business. Now, if this were a publicly traded company, this calculation would have no meaning because we wouldn't have to do this, but it's a small business and the owner is, or the owners are going to guarantee the loan, and so we want to subtract it. So that's the first calculation, the outside net worth. And then there's another one, which is called the adjusted net worth, or ANW for short, where you take the outside net worth and you basically go back through the balance sheet and you say, which of these numbers should I discount? Either eliminate completely or adjust downwards. And so, for example, if you think back to the problem that you had from chapter 12, those receivables from friend or from the family member, automatically, I would take those off, right? But on this particular problem, we're taking off, they have an 8% interest in another company. Now, this company is not being loaned to, in my example, but the point is, it's another entity that is providing them with value for their assets. But for our purposes, we're discounting that. And then, and by the way, if this were a publicly traded company, I would not take this out, because if it's publicly traded, it means then that their performance is not going to have a direct impact on the value of this asset. It's a marketable security, so I would leave that in. But in this case, it's a private entity. They own 8% of it, and so I took that out as well. And then I took out their personal effects. Okay, this is where you will have some flexibility in terms of what you take out and what you leave in. So for example, you could argue, well, I'm taking the jewelry out if they have jewelry. Well, it depends on what it is, right? You could argue that you're taking out a percentage of the value that they show for their personal residence. Maybe you would do that if there is no appraisal. But technology is such now, as you probably know, you can go to so many sources and you can get a very good idea of what the market value is for a particular property. So you will have to make some judgment calls based on the information that you have from the guarantor or guarantors, and you adjust accordingly. So ultimately, in this example, I came up with an adjusted net worth of 355 for the first year, and it went down, oh, I guess I had a typo there, to 260,000 for 19x3. I'll have to double check that. Someone can check my math here, but this is 463 minus 48 minus 55. I think this may be a little bit too low, but it should be 260,000 according to what I have here, but I think that's a typo. The bottom line is, once you get to this number, you are asking the question, so what exactly is the value that the owner is bringing to the table in terms of their guarantee? And when you look, for example, at this number here, it tells me that the bulk of this is made up of two things: their house, as well as their marketable securities and their cash. Not bad, but just so we know that that's where the value is coming from for this particular adjusted net worth. And let's not get too excited about the residence being, a high value, because you will not be able to easily liquidate someone's home in order to pay off a debt. But this is what tells me the value that the guarantor or guarantors bring to the table in terms of their net worth. And so if I am lending, $2 million, this does not really impress me, right? But if it's 200,000 or 150,000, then the situation changes a little bit. Any questions regarding any aspect of this? Because I think that is it as far, yes, that's it as far as my PowerPoint slides are concerned. Do you have any questions regarding the ratios and the adjustments to net worth to get your adjusted net worth? Nelson, how am I doing on time?
We're good. We have a couple minutes left. The only question I have is,
yes,
on the last one, how come it's almost $100,000 less? I'm still confused looking through the numbers.
Okay, you're talking about the 19x3?
Yeah, how it's 260 instead of 355.
Yeah, double check my math on that one, Nelson. So it's 463, which of course is the outside net worth. And then you see the $48,000, which is the 8% interest in this limited partnership. And then the 55, which I took from here, right? You see this 55 right here? So just double check on your calculator. 463 minus 48 minus 55. This is 103, right? This is 103. So 463 minus 103.
That should be 360.
So it'd be 360. Okay. Yeah, I looked at it.
Yeah, that makes more sense.
Okay, so does that make you feel better?
Yeah, I was trying to figure out how it was 100,000. Like, what?
Yeah, exactly. So it's a typo. I apologize.
Okay, okay.
I should have done my homework before putting it up, but I must have hit a wrong button and didn't realize it. But mathematically, it's wrong, right? But to get to it, you take the 463 and you deduct these two, and so it should be 360 something as opposed to 200. One of the good things about this particular hypothetical guarantor or guarantors is their financials really don't fluctuate a lot. But of course, that's what happens when the numbers are hypothetical, right? The real world presents you with a totally different situation. So again, remember what you're trying to do here with your adjusted net worth is, and honestly, this is really your call as the lender or the analyst. You are going back through these things and you're saying, okay, this value that you're showing for real estate is too high. Remember I shared with you the Trump fiasco last week. That's the kind of scenario that you're faced with, where you're looking at the numbers and you're saying, these numbers do not make sense, okay? And so when you're making your final decision or your final recommendation, this would be one of the things that you look at and you say, you know, it's nice to get the guarantee from the owner or the owners, but let's be clear, we're not really getting a big bang for the buck here, because when you adjust for things that are either inflated or things that are just not of any material value, then you come up with a totally different number. So we're coming from over $1 million all the way down to $360,000 or $366,000. That's a big drop. By the way, I should also share this as we close out this section. One of the things that is very good about this CPA prepared financial statement is they estimated, you see this liability down here? They estimated what the tax liability would be if the assets were liquidated and all of that. And so in a way, what you're working with is a very conservative number. Most likely, these individuals will not be paying this kind of money in taxes, okay? A, they have no plans to liquidate all their assets, and B, we are using a calculation that is not based on the actual event, and so it's an estimate. It's sort of like your deferred tax liability that you would see, for those of you who may remember this from your accounting exposure. It's like your deferred tax liability, which you will never have to pay as long as the company continues to perform at a certain level. So it's actually assumed to be equity. So this number here that we're looking at is very conservative because it already took into consideration this estimated tax liability from the very beginning when I started the calculation. Any other questions? Next week is going to be interesting because we're going to be getting into tax schedules. And I will just let you know, as you read chapter 14, we are not going to be doing a tax class, okay? It won't be a class on how to prepare income taxes, as helpful as that may be for some individuals. What we're trying to do, or we will be trying to do, is getting a better understanding of what is actual income when we look at the tax returns of an individual versus earnings that are taxable. So we'll get into that in next week's class. But for now, I think this is a fairly straightforward chapter. The only part that may prove challenging is coming up with the adjusted net worth. But there is a certain amount of subjectivity to it, even though there are some general guidelines as to things that should be taken into consideration. All right.